And well, in this edition of Traders 20 as well as the Buy Now Sell Now on campus, we take you inside NMIMS, one of the top management schools in the country, where the students will interact with market experts and understand the dynamics of the stock markets, the art of investing and the mantra for wealth creation. Avan Dubash is standing by and is with the students of NMIMS. Avan, take it away.
Thanks very much for that, Kamya. Yes, I'm in Premier B School, NMIMS, Mumbai. The excitement is really palpable. I've got a whole bunch of first as well as second year students who are specializing in finance. So I know that this is going to be a very interactive next half hour or so. In fact, just let me run you through what this show is all about. We've had an absolute success with BNSN on campus in the last 2 editions, and we hope to replicate that success with the very bright young students here at NMIMS. So over the next half hour or so, we're going to be interacting with our market experts and have lots of questions as well on their pearls of wisdom, the basic do's and don'ts of investing, as well as what are their top ideas on the show. So without any further ado, let me introduce our experts who will be with us. Joining in on the show today, we have Ajay Bagga, market expert, as well as Mayuresh Joshi, fund manager, Angel Broking. Gentlemen, lovely to have you with us on BNSN on campus. I'm sure being here brings back lots of memories of B School. But let's just start off with the basics, and a point that I'd like to really bring across to you guys is that I think a lot of people look at the stock markets as a bit of a casino. You go in, you put your money, you make your quick buck and you're out. But I think like Ace Investor and our guru Warren Buffett said that the stock market is like a device where there's a transfer of money from the impatient to the patient. Ajay, do you think that that would be one of the key points to keep in mind?
Yeah, definitely. And, thank you for the opportunity to eating off for being here. Thanks to NMMIS. I think what you need to remember when you get into the stock markets, what the father of value investing, the guru of Warren Buffett in turn said, that in the short term markets are like a voting machine, and in the long term they are like a weighing machine. So in the short term, momentum, fads, fashions determine the speed and the direction of the market, but always in the long term fundamentals win out. So it's like a sprint versus a marathon. What Avan said, impatient versus the patient, and patient will win. This is where the tortoises win, not the rabbits. Remember, that's the stock market.
Mayuresh, let's come to you as well. And a lot of people tend to get very nervous when they put their fingers into the stock market. Things don't go out as planned, you get your fingers burnt there. So what would be some of the key principles or points that you would advise first-time investors?
So morning, Avan, and thanks for having me here on the show. So clearly, I think, as Ajay was pointing out, it's more patience testing mechanism, and this is not a place that you go in for a quick buck. So this is not something where, as Avan was pointing out, this is not a casino, this is not a gambling den. There are basic fundamentals, there are valuation parametrics that we look at, there are payoff matrices that we probably work out with. And valuations, core fundamentals, companies having good governance is something that we ideally need to watch out for. How do you probably do that? I think you need to do a lot of research. You guys being in finance, I think learning finance should understand the business models. The business should be very, very simple and easy to understand. So if it's very complex and the basic nature of the business itself is highly unstructured, you're not going to have a great understanding on how the business metrics are going to pan out. So I think ease of running the business, if the business model is very, very easy to understand, if you can extrapolate numbers in a much easier fashion. I think that are some key points to look at. The management has to be good, the corporate governance has to be good. So I think if you have a long-term investment horizon, don't get swayed by these short-term fluctuations, market volatility, which will always exist for some reason or the other. I think you should be making a decent return on investment on your money.
And thankfully, Mayuresh, we have a very smart bunch of students with us who hopefully have been investing, and it's on the learning curve right now. But here's another big mistake that I've noticed with a lot of people that you interact with, especially first-time investors. It's, so-and-so said, a friend said, I should invest in this stock, so I'm going to do it. And no one really points out the times that they've lost money. They're only highlighting the times when they've made the big bucks. So you sort of tend to get convinced by that. So what would be the advice when it comes to, taking tips from even a friend or a relative? How should one really deal with that?
So I think the moot question here is to do your basic research, and you guys being students of finance, I think the basic understanding financial statements should be quite easy to use. So I think the kind of tips, speculations, or following a herd mentality should probably be avoided. Because a friend has taken the stock, because somebody's told me to buy this, and probably the stock has moved up, say 10-20%, I think the initial reaction becomes that I should move into the stock. But again, I think, as I mentioned earlier, I think there is no quick mechanism of making a quick buck here. You need to have long-term patience. You do not need to move in for speculative tips or news items which are probably driving up these stock prices. Clearly, I think the balance sheet will tell you everything that the company is posting. And again, I think there are a few exceptions when balance sheets have probably misled even experts like us. But clearly, I think if you look at the core numbers itself, and if the business model, as I said earlier as well, is evolving very nicely through economic cycles, I'm pretty sure that if your investment horizon is long term, I think understanding these fundamentals of the company should not be of such a great hassle to you. And clearly, I think speculation, tips, chasing stocks, I think that should be avoided.
Okay, those are some of the key avoids, and of course the balance sheet tells the story. Now we get to the exciting part where we go across to our students and have them ask some questions to you guys. I know you're waiting to ask all of the stock-specific questions, but introduce yourself and what you have for our experts.
Good morning, sir. I'm Kunal Chatwani. So I have been investing a bit in the IT and the banking sector, but I'm looking to expand now. So lately we have been seeing that in the pharmaceutical sector, about ₹1 trillion have been wiped out from the market cap of firms like Dr. Reddy's, Cipla, because of the US FDA warnings and import alerts. So is the worst over for these companies now, or should we wait for some more time before investing in these companies? What would you have to say about that?
Ajay, Mayuresh?
Yeah, what has happened in pharma is that FDA has got very active, and they've increased the inspection fees, and they're using that money to increase inspections in turn. I think the pain is here to stay. It will take some time. So I would recommend getting out of big pharma at least, and it's going to become tougher. You will see more news flow like this. Valuations were already stretched, and market has hammered the sector. If you see November series, sector was down 9%. Some stocks are down as much as 25%. Have you reached a value zone? I don't know, because this is an emerging threat still, and clearly they have to fix this. Even for the country, it's bad, because we were looking at this growing into a 100 billion, 150 billion export kind of a monster. The way we have the IT juggernaut exporting every year, it was good for the country. So it's been a management failure more than anything else, not being able to do these compliances properly. So hopefully now they set their house in order. Will take 12 to 18 months. So it's not an easy fix. So might be better to get out of it and reallocate your money into some other sector.
Thank you.
So hope that answered your question. And indeed, Mayuresh, sticking with the pharma space, they've swallowed a very bitter pill so far. We've only been getting negative news. The pharma index has been falling, and how anything you'd like to add? And I know you have, a fairly bullish call on the pharma space. You say invest in select pharma stocks. What's it that's on your radar?
So clearly, I think, as Ajay was mentioning, I think the FDA concerns are largely plaguing the industry as a whole. But again, I think the opportunity is quite immense. So the off-patent generic market itself across products and the kind of ANDA filings that a lot of these pharma companies have got specifically with the US markets, that poses a huge amount of opportunity for these guys. Having said that, as the one was mentioning, I think the valuations are a tad bit on the higher side if you look at the historical averages. So stock-specific approach is something that one should ideally follow within this sector. Stocks like Sun, Dr. Reddy's, as you were mentioning, I think have got hammered down. But the reasons again have been very, very obvious. So I think the kind of import bans that Sun Pharma's acquisition of Ranbaxy and the Halol plant itself, I think that EPS impact is going to be large over FY16. But has the market largely factored that in with the kind of correction that we've seen and the trimming of estimates specifically on the earnings side, on the consolidated front? Sun Pharma has largely discounted, in my opinion. Again, a qualitative franchise, large amount of ANDA applications, again the geographical niche presence that it gets with Ranbaxy is going to be huge. So I think Sun Pharma is something that I really like with a long-term perspective, and by long-term I really mean long-term. It has to be more than 2 years, 3 years. It cannot be 2 quarters or 3 quarters. And again, similarly with Ipca Labs, I think it has faced the brunt for similar FDA issues But clearly, I think if those concerns are sorted out over the next few quarters, the normalization of return on equity should be quite evident for IPCA. So something like an IPCA Labs also looks good in declines.
Okay, so we've taken note of some of those pharma names, but tell you what, we'll take a quick coffee break right here and toss it right back to you for some exclusive news, Kamya.
That's right, Avan. In fact, some interesting investment thoughts there. But let's just shift focus and talk about a stock which has almost doubled in the last 3 months. And that stock from the media space is Balaji Telefilms. Ajay Sharma joins in from our research desk to talk about exclusive details of a transaction. But Avan, you were discussing about the pharmaceutical space. How about getting some thoughts on the media basket as well?
I think I'm going to do just that. Actually, we just had an exclusive story talking about some investments in the media space as a whole. Balaji Tele, that's a very hot stock within that sector. And by and large, you know, we have seen a lot of interest pick up in the media space as a whole, be it the exhibition stocks. We've had some great releases as well. There's also been Dish TV, some turnaround stories over there. What's the view, Ajay, when it comes to media?
Media is basically look at media as the Indian consumption story. So there's only one way upwards. Hate the managements who are anti-minority shareholders and who take on too much leverage. So again, as Mayuresh said, read the balance sheets. For me personally, nothing better than the balance sheet and especially the notes to the account. See what the auditors are qualifying. That is even better than the numbers. Numbers everybody has. Anybody can analyze, but going deeper into it. So media, I would say yes, a resounding yes, get into media, but stay away from companies which have not rewarded minority shareholders, stay away from managements which have taken out too much leverage. That's or big mergers, anybody does run for the exits.
What about looking at the films for the exhibition stocks, the Prem Ratan Dhan Payos, the Spectres? Have you seen any lately, Ajay?
I don't get time. You guys keep calling us to the studios, you know, and with the hours extending for business channels, that's what we were just exchanging notes. But no, films, again, you know, the funding is not institutional. So the flows don't come back into an institutional play. If you see, it's mostly in the private play. So unfortunately, we can't, you know, really benefit from the films, but you can benefit from the exhibitors, as Avan said. So somebody who owns the cinema houses and, you know, so you spend 1,000 rupees on 2 tickets, but you end up spending 1,000, 1,500 on the eats there, and they don't allow you to take anything else inside. Good models, but look at the valuations, look at the margins, look at the valuations. Real estate is very expensive in India. So anybody trying to do something based on real estate, like the malls, when they came in, they said Lucknow will have 60 malls. Everybody wanted to get into malls. That's the time to short, when everybody's talking about it and is very gung-ho about it. So contrarian, reading, doing your own analysis. You know, that is critical. Yeah. Somebody asked Warren Buffett, again, we are quoting him extensively because we want to impart the right, you know, lessons to you. They said, what is the one best thing that I could do? He gave them a sheaf of balance sheets, said, I read 500 pages of these even today at 85. So can you read 500 pages? Yeah. Put that challenge to yourself. How much of the balance sheets are you reading? You just see, you do that homework, do that perspiration, inspiration will come, you'll find something. Mostly you'll find skeletons because of creative accounting, but you'll find something which the market has also not looked at, or you will find, you know, conviction that what you have thought is really borne out by the numbers.
Yeah, that's a really interesting point, Ajay, because even, you know, some of the people in the office, Nikunj, for instance, who we interact with all the time, he says, I'm here every day to keep learning. I mean, there's so many new things that you can pick up. I'm not saying just by balance sheets, but by talking to people, interacting with people. Mayuresh, I don't know if you've had any time to catch any of the films, but hot on media or not?
Yeah, I take plenty of time off over the weekends to catch some films. So yes, I think the exhibitors, as Ajay was mentioning, I think that private space probably is looking good. But again, I think the important aspect here is the kind of cash flows that they generate and the kind of additions that they need to make over a period of time in terms of core screen addition. So in that sense itself, I think the FCFs, or the free cash flows, are very, very minuscule for a lot of these exhibitors, and they need to keep on expanding. So yes, I think on decline, some of the exhibitor stock look good. The print media is apparently looking quite good at this point of time.
And you like Jagran?
Yes, and I like Jagran at this point of time. I think the newsprint prices have gone down massively. So I think the operating leverage that probably comes through with increase in advertising revenues, subscription revenues coming up, and inching again in the Hindi reading belt, I think that augurs well for stocks within the print.
And if I can interrupt, Avan, since we are learning, how many of you actually read a newspaper as a paper still?
I'm very old school.
Oh, okay. So all are old school. You do read papers. I stand corrected.
Yeah.
Because
even though digital is taking over, I think a lot of people prefer the good old newspaper.
The look and feel.
Yeah.
Great.
But some of the backbenchers, they're also paying attention and they've got some questions. Go for it.
Hello, sir. Manish Agarwal. Sir, there are generally two schools of thought about investing. Like there's a fundamental and there's a technical aspect. So, sir, as we are talking about we should go for the fundamental aspect and look at the balance sheets and everything. But, sir, when we look at the technical school, that also has a lot of followers. And the lagging indicators, if I talk about moving average, sir, I've been following particular stocks like at the State Bank of India and SpiceJet. Lagging indicators have given very well returns, as in they give a very well indication of how the stock will be performing. So do you see in the future, maybe if we can not exclusively use either one or the other, but maybe an inclusive approach of fundamental and technical approaches, maybe a lagging indicator and the fundamentals together? Is it possible in the future?
Definitely, yes. I'll say before Mayuresh goes in, both of us are fundamental. So that's why you are seeing a bias towards
no talks of technical indicators here.
So, but the technical guys will say that fundamentals are all discounted in and the technicals really show. And there are some technical wizards who don't do any technical analysis during market hours. They say, I will only see at the end of the market, and then tomorrow I'll shut out the noise and just trade based on my technicals. So there are extreme views on both sides. For us, we want to make money. So I use both technicals and fundamentals. I have not got any purist idea that I can't touch this. So if something is breaking the 200 DMA, I'm very very happy to see that. It's giving me a direction. And then I use my fundamentals to see whether it's getting borne out. A lot of time, and one interesting thing. So the short answer to you is use both. Learn both. Use both, don't leave out anything. We are here in the quest for knowledge and to make money based on knowledge. So learn both. That is one. Second is when momentum is against you, don't try to be Superman. Because, what did Keynes say? He said, the market can stay irrational longer than you can stay solvent. So you might be right, but it might be too late to help you out. So their technicals helps you. Technical tells you, boss, this market is looking bad, or this market is turning around, and if it's turning around and you're sitting in shorts, get out of it first. So I would pay respect to both.
I don't know about Superman, but we have some future Sandeep Wagles and Mitesh Thakkars in our audience for sure. Mayuresh, you'd like to add?
So I concur with Ajay totally. So I think you need to pay heed to both studies. And again, I think as Avan was mentioning, we are in the learning curve. So I think Ajay would concur on that aspect as well. We're learning every day. Even on my part, I think we're learning more about industries. We're speaking to a lot of management. And it's an holistic effort that probably comes through. Just pure reading balance sheets will not give you the inherent knowledge that you're seeking out. You need to speak to a lot of people and so on and so forth. Technical, apart from that, I think if you're just looking at technicals, I think keeping the strict stop loss is of paramount importance. So always remember that in mind, because that is a very, very short-term call that you're probably taking. You don't want to go deep out of the money, probably, right? So.
Okay, we've got lots of stock advice, but I'm going to hand it right over to the studio. We've got some more breaking stories.
That's right, Avan. In fact, it's about the banking secretary. Ruchi joins in with more details on that. And Ruchi, the government panel under MOS Finance would be dealing with NPAs. Share more details on the same, please. Welcome back. Let's quickly take a look at the markets at this point of time. Sensex and Nifty both holding out very smartly, 0.6% higher. The broader markets clearly outperforming the benchmarks at this point of time. Mid-cap higher in trade by 0.6%, but small cap doing exceedingly well, a good 1% of an uptick coming in there. But this is BNSN campus, where we take you inside NMIMS, one of the top management schools in the country, where the students are interacting with market experts and understanding the dynamics of the stock markets. Avan Dabash is standing by. Avan?
Thanks for that, Kamya. We had an interesting break also where we were chatting with our experts about some stocks to look at. Ajay promised us that when the cameras are turned off, he's going to divulge details. But our students are waiting by with lots of questions, so let's take it away. What's your query?
Hello, my name is Vishesh. So apart from the asset quality, the payment bank are being perceived as major threat for the banking system in India. And with the traditional banks entering into this space, so should we see this threat as a short-term threat or a long-term threat?
There is no threat, it's an opportunity. So these kind of changes, disruption, innovation, it's not happening for the first time, it's happened throughout life of humanity. All the big banks will benefit from this. So fintech as such is getting a lot of funding. They are coming out with a lot of new innovations. All of you are joining e-commerce and fintech startups. You don't want to work with the old world companies. But the old world companies have a lot going for them. They have business models which throw out a lot of cash so they can invest. They have a lot of judgment, a lot of good management sitting with them. And third, they will buy out the fintechs. They will buy out that technology, and that technology itself will get disrupted. So I see the payment banks as expanding the reach of financial inclusion in India. All the big banks, if you see, they have launched their own version of payment banks already. But it will really make it very easy, very frictionless to do banking in India, and it will expand the pie for everybody. So if you can invest in a payment bank, do that. They're all unlisted. As an angel investor only you can, at very high valuations, or go and invest in our private sector banks at 2 times, 3 times book, or in our public sector banks at less than 1 time book, if you have a 3-year perspective.
So bank on the banks, that's the word coming in. But
nice.
I don't want to be the only woman asking the questions. We have another one.
Hello sir, my name is Riddhi. My question is, the railway stock has suddenly become attractive. So is there high hopes from the railway budget?
Mayuresh?
Okay. See, it happened last year as well, when the government was still new. Now it is 18 months old, and there was a lot of talk of refurbishing railways, new contracts. And our point was that railways cycle is nearly 3 to 5 years. Like defense cycle is even longer. Defense is 5 to 10 years. You and I can't decide one day and say we'll start making submarines. We used to make bathtubs till yesterday, but tomorrow I'll make submarines. Doesn't happen. Market runs ahead of itself. So now finally I think railways is catching up. We are expecting quite a few orders to come through, and markets, because they front end by about 6 months, they are taking that in. But again, it comes back to what are the parameters you should look at. When you look at it, look at what is the execution capability. If somebody's turnover is 100 crores, do you think they'll be able to handle 2,000 crores of contracts? Scaling up becomes an issue. One. Second, what are the margins? We saw in the road sector, for example, people overbid at very thin margins. They all went bust. Out of the 28 big road projects, 3 years, 4 years back, about 19 are bankrupt. And that is what bankers have lost out. That is what private money has lost out, and taxpayers like us have lost out. So again, when you go for all this, look beyond the hype and check out for yourself. Otherwise, let it wait. Don't remember always, you think that I lost money. Why? There was an opportunity, I didn't invest. You did not lose money. Your money is still lying. When you lose money, when you invest in an opportunity, that never crystallizes, and that stock goes down. That is when you have lost money. So never have this fear of missing the bus. There will be other buses coming continuously. India is a growth economy. You are very lucky to be young at this time. In the Indian economy, in the global economy, there's so much happening all around us. You will never miss the bus. So never think in those terms.
Okay,
just to add to Ajay's point, specifically with railway stocks, so the kind of order wins that Ajay was talking about, that should probably start coming through. But this is a cycle that you need to understand. So order flows coming in, as Ajay was mentioning, do you really have the fixed asset capability to have those turnover ratios come out and churn those orders in terms of execution coming through? So orders coming through, whether you are able to execute that properly, if you're able to execute that properly, how much of an ease it causes on your working capital. If that causes an ease on your working capital, the margin expansion happens. Because of volume growth, the operating leverage kicks in. Because of these two factors, the earnings growth starts kicking in. But it's not an easy cycle to play out. So you need to give a longish period, as Ajay was mentioning. So it's not something like an order win comes through in 2 quarters, the numbers start coming out on balance sheets. So you need to give a longer time horizon, and this entire cycle has to play out meaningfully.
Okay, so we've dissected banks as well as pharma, spoken about railways. Let's get some questions in from you as well.
Hello sir, I am Uday Dangra. Sir, we have seen in last couple of years IT and pharma stocks rallied many folds, while most of the banking and metal stocks were not able to touch even their previous highs. So my question is whether this trend of IT and pharma sector outperforming market will continue, or it will gonna soon reverse.
Mayuresh?
So clearly, I think the outperformance has been quite evident based on 2 factors. I think in times of economic cyclical downturns, you turn out to these sectors because these are relatively giving you an earnings comfort. Secondly, I think with the kind of US business generation that these companies had, as I mentioned earlier, there is some amount of respite when it comes to the earnings parameter in terms of visibility. So I think whether these earnings growth will continue, because you're probably talking about pharma companies, as I said, the valuations are a little bit stretched on historical basis, and clearly IT companies are looking good. So I think if you exclude the next 2 quarters, which are traditionally weak, Q3, Q4, there are a lot of furloughs, you've got client spending exercises coming through in Q4, FY17 would look much better. So I think top IT is something that I'd prefer, but you need to keep that horizon of rolling over numbers over reference.
Okay, I'm afraid I won't be able to take any more questions, but I have one question I think on behalf of everyone. Mayuresh, your top picks, and Ajay, your top sectoral picks in the next 2 minutes.
So Aman, I think we like a few sectors. So within autos, I think Maruti is something that we really like, but you need to wait for decline because the risk reward probably is a little bit on the softer side. So Ashok Leyland is something that we'll continue to like within the auto ancillaries, Forgings, TVS Sri Chakra in the tire space. Cement is a theme that we believe, and again it's a belief that the capex cycle should resume over the next few quarters. If that happens, utilization levels going up, return ratios improving. So Ultratech, JK Cement, and we like a few mid-cap companies. So Inox Wind in the renewable energy space, but the government has a lot of focus, and the other stocks that we discussed now.
Ajay, where do you put your money? Where do you stay away?
I would stay with Mayuresh. He is a very safe fund manager for me. So autos, cement is turning around. So cement, you can't go wrong. Go ahead and buy cement, because roads are the way roads, and then affordable housing is talking 200,000 crores per year. 13% cement demand comes up, no new plants coming up. So buy cement, buy auto of any form, from 4-wheelers, 2-wheelers, commercial vehicles. Buy private sector banks, evergreen, can't go wrong again.
And stay away?
Stay away PSU banks for now, at least next couple of years. Might be some people will make money, but not necessary. It's a long-term story until big bang reforms come in. And second, infra. The high leverage cases, you're seeing a lot of turnaround stories being bandied in the market. Stay away from those. So very high leverage, stay away.
Okay, Ajay, Mayuresh, I know I'm speaking on behalf of the entire classroom at NMIMS that it's been a great session. Do you guys agree? Yeah. So thanks so much for joining in on this edition of BNSN on campus. And with that, it's back to you.